Hello and welcome to day 2 of this conference on fintech and COVID-19, which is jointly organized by the ADB Institute in Tokyo, the ADB, and the Cambridge Center for Alternative Finance. Today's program comprises 2 keynote speeches, the first one by Amy Neal of MasterCard, which will take place right at the beginning, and the last one at the end of the day will be by Feng Zhu of Ant Financial. In between the 2 keynote speeches, we will have 3 research paper presentations. The chair of the first session today, the first keynote speech, will be Brian Zhang of the Cambridge Center for Alternative Finance. So I would pass the floor to Brian now. Thank you.
Thank you very much, John. Good afternoon and good morning. Welcome to the second day of the virtual conference on fintech and COVID-19, co-organized by the ADBI, the ADB, and the Cambridge Center for Alternative Finance at the University of Cambridge Judge Business School. It is my great pleasure to introduce our opening keynote speaker for today, Dr. Amy Neal, Senior Vice President for FinTech and Enablers at the MasterCard. Amy has a long and distinguished career in academia, entrepreneurship, open innovation, and now leads the award-winning Start Path program at the MasterCard to support a diverse portfolio of more than 250 companies, of which many are fintechs across the globe. We also know that improving access to finance for consumers and SMEs, gender empowerment, and inclusive growth are important areas of work for both the MasterCard and the MasterCard Foundation. During COVID-19, these issues have become more pertinent with profound implications on people's lives and livelihoods. Therefore, we are very grateful to Amy for joining us today and delivering her keynote address on fintech for choice, access, and inclusion. I would very much encourage you all to post your questions in chat for the Q&A later. Amy, thank you, and the floor is yours.
Thank you so much, Brian, and welcome everybody. It's my very great pleasure to join you all today. If you can bear with me, I will share my screen for a few slides on the topic of fintech for choice, access, and inclusion. So I hope everybody can see my slides there. Maybe somebody could just let me know that that's visible for you.
Yeah, looks good.
Thank you, John. So as Brian has said, my name is Amy Neal. I am the Senior Vice President at MasterCard with responsibility for a group that we call the Fintech and Enablers Group. And that encompasses a few activities that we carry out as an organization around the fintech space, including, as Brian has said, our startup engagement activity. And it's been my great pleasure over the past number of years to be able to work with many fantastic, fast-moving fintechs. And I'd love to share with you some perspectives on this work today. So I think we probably all agree that over the last decade, the world has really made significant progress towards greater financial inclusion and to providing traditionally underserved people with access to the basic financial tools that they need, whether that's to get paid, engage in commerce, or build the savings, the credit, the insurance, and the other key building blocks of their financial security. And the transition to digital was already well underway as we entered 2020. But of course, as you've been hearing through the conference, the pandemic simply supercharged access to digital and approaches to digital in financial services. And now digital being digital isn't just a matter of convenience. It's about people's entire lives. It's about their health, their jobs, and their ability to thrive. Over the last 10 years, as well as seeing great steps forward in financial inclusion, we've also seen the emergence of fintech, which in many ways has been about the unbundling of financial services and then the subsequent rebundling in new ways. And as we look at the next big click forward in fintech, what we see is what's frequently referred to as embedded fintech or embedded finance. And I like to think of embedded finance as an approach to financial services that truly meets people where they already are. And to me, this is real financial inclusion. Driven in large part by digital, embedded finance has the ability to enable more people to be included in the digital economy by meeting them in the places and spaces where they already are occupying. And what I'd like to talk about today is how this next click of fintech is about offering choice, creating access, and taking conscious steps to include more people. So maybe let me start by providing MasterCard's lens on this topic. 5 years ago, my company committed to bring 500 million excluded individuals into the digital economy. And in 2020, in the middle of the pandemic, we formally announced that we'd achieved this goal, and we set our sights on reaching another 500 million people by 2025 for a total of 1 billion individuals who had previously been excluded. Alongside that goal, we also committed to helping 50 million small and micro merchants with a direct focus on providing 25 million women entrepreneurs with solutions that can help them to grow their businesses. So I'm well aware that these are big numbers. And these goals, to achieve these goals, they're deeply embedded within and across our business, with teams from product to treasury to sales and go-to-market, thinking about how their efforts will achieve these goals. In fact, just last week, we made a public commitment that executive compensation will be tied to 3 global ESG goals of carbon neutrality, gender pay parity, and of course, financial inclusion. So all of this to say that purposeful innovation in fintech and financial services is deeply embedded in the way that MasterCard is doing business. And this phrase, doing well by doing good, is our way of doing business. And as I talk to you today about choice, access, and inclusion, I do so to try to highlight how new approaches must be accompanied with tangible commitment. What comes next is as much about commercially sustainable solutions that have social impact as it is about technology. Technology itself can create opportunity, but only if it's guided by the ethics and values, decency even, to innovate for inclusion. And digitization done the right way solves problems, and it also fosters inclusion. And that includes having diverse perspectives and backgrounds around the table at all levels. So let's dive in. At MasterCard, we have a long history of working with fintech innovators. And it really is truly incredibly exciting to have worked with emerging players over the last 10 years. There's been tremendous change and opportunity in the fintech space, fueled in large part by new available capital. And this capital is simply not slowing down. Despite COVID, 2020 saw over $45 billion in venture capital investment going into new fintech ventures. And this was the highest year on record. The opportunities are vast. I spoke a moment ago about embedded fintech, a trend that's predicted to be a $7 trillion market by 2030. And by 2024, it's estimated that there will be almost 100 million neobank users across the globe. But it isn't just about capital and scale. Fintech is really about entrepreneurs like Georgina, the founder of True Rating on this slide, who really want to make a dent on the universe. They're committed to building mission-driven, sustainable businesses with purpose and a true commitment to change. That's why our work at MasterCard in the fintech space has always concentrated on what we like to call like-minded rabbits, the real, actual businesses building interesting technology. And as we partner with these rabbits and think about what's next, a number of market forces, including the pandemic, are shepherding in changes that are accelerating our ability to drive innovation with fintech partners across the globe. For example, the way technology is being shared and consumed allows us to deliver enhanced experience via open APIs. New approaches to partnership in the fintech space are bringing more people into the digital economy. New ecosystems are being developed, which bring the importance of data to the forefront in areas like open banking. And the expanding digital assets landscape is providing consumers with more choice in how they want to pay and get paid. We're incredibly excited about the next chapter. As fintech innovators are contributing to rapid digital transformation, that makes consumers' lives more convenient, simple, and rewarding, we at MasterCard are supporting this creative disruption in a number of ways. We're helping fintech startups to scale through our dedicated startup engagement program that we like to call StartPath. We support developers, developer teams, engineers within fintech companies through the MasterCard developer platform with APIs for everything, empowering engineers to access our solutions. For fintechs that want to embed payments, we have a regional Fintech Express initiative that provides a single point of contact within the company and provides a customized set of rules and resources. And through the MasterCard Engage platform, we can connect fintechs to hundreds of trusted technology partners, making it quicker and easier to work together with providers at all stages of the customer journey. So outside of MasterCard, what I'd like to do today is bring the topic of fintech and COVID to life by sharing some perspectives on how fintech enables choice, access, and inclusion with some global insights. So let's start with a focus on choice and specifically how open banking is enabling that choice. So imagine you've been retired for a few years. You've paid off your mortgage, you don't have other loans, and you're financially secure. You want to borrow some money to help one of your children to purchase a home. Now consider a very different situation. You're a recent immigrant and you need a loan to open a new business. In both of these cases, a lender could sometimes reject you, not because you have blemishes on your credit report, but actually because there isn't enough up-to-date information in that report. In the traditional credit scoring system, if you haven't borrowed money recently, it's almost as if you don't exist. So taking root in the financial world today is a simple concept that could change how people interact with their money. And yes, in both cases, it could help you gain access to that loan too. I'm sure everyone in the audience is familiar with the concept of open banking, but let's talk about that for a moment. At its core, open banking technology is software that lets you give lenders or fintechs access to some of your banking data. It's akin to the privacy permissions on your phone that allow you to open an app, and allow that app access to your camera or your storage. And as with app permissions, you are in control of how that information is shared. You have the choice over what you share and with whom. This technology is part of a revolution in commerce and banking, with consumers embracing digital payments more quickly than ever before. In our new post-pandemic digital world, open banking empowers consumers to make the best financial choices for themselves, and it can bring more people into the global economy by making it easier for them to save and to send money. We recently carried out consumer research that demonstrates that 70% of consumers globally said that they would be likely to use an open banking enabled solution to manage their personal financial affairs. Open banking will ultimately help just about everybody with a credit card or a checking account to get more out of their relationship with their bank. It gives you the ability to take financial data that's usually housed at your bank and to have it start working a lot harder for you. It should also build more trust with millions of consumers by giving them more control over their information. For instance, you probably have accounts with a variety of banks and apps, and open banking could eventually let you move that information for all of those different accounts into one real-time dashboard, all of your choosing, so that you can see all of your money in one place in an atmosphere where your financial information is well protected. With all of that information brought together, personal financial management tools can be overlaid atop that information to give you deeper insights into your spending and your savings. The potential for that kind of simplicity and convenience will encourage financial services companies to keep innovating, to make sure that they're providing consumers with the very best user experience, knowing that you may start using a different service if you aren't satisfied. Added to that, open banking will increase access to credit to help a lot of people who couldn't previously get loans for home down payments, school tuition, or even new vehicles. If you decide to use an open banking service in applying for a loan, and millions of people already have done that, you allow a lender to verify your income and look at your cash flow details, including cash balance and spending patterns. And those details together can offer a far better picture of your creditworthiness than a single credit score, which is what's accessible today. Often those credit scores don't offer an up-to-date picture of your finance if you haven't borrowed money recently. And these open banking services will fix that problem. Because of PSD2, Europe is already well advanced, and over 450 third-party providers have already registered to provide open banking solutions in Europe. I find this kind of technology so exciting because it helps people take advantage of valuable financial tools that were previously just out of their reach. It's these kind of services that our hypothetical borrower, a retiree, or a new immigrant, or really anyone else can secure a loan. That kind of work will bring many more people into the digital economy, strengthening it and making it a more equitable place. And this greater convenience and broader access can't be achieved without trust. As technology companies and banks develop ways to put your financial data to greater use, there must be controls, there must be transparency, and there must be a system where data gets used only when consumers grant permission. That means that the consumer needs to be at the center of what we do as we create this new ecosystem. And done right, it can create more financial opportunity for everyone. So what about enabling access? The global pandemic and accompanying economic impact have severely disrupted supply chains and trade networks, particularly for small and medium-sized enterprises, which account for about 90% of all global business, employ about half of all workers, and deliver more than half of GDP. The pandemic has also reduced control over cash flow and access to credit by SMEs. It isn't just about consumers. Even before COVID-19, the Asian Development Bank estimated that there was a $1.5 trillion funding gap back in 2019, with smaller businesses most impacted. The International Chamber of Commerce estimates that a potential $2 to $5 trillion shortfall in trade financing through 2021 if demand returns to the global economy. As a result, it's absolutely vital for the public and private sectors to come together to enable a faster and more efficient shift towards digitalization for SMEs across global supply chain, trade, and access to finance. So in September last year, MasterCard and our partners in the fintech space, NFriends, SGBiz, and Finastra, formed an alliance with support from the Asian Development Bank to create new technology solutions to drive greater digital efficiency across retail supply chains in Asia and to increase wholesalers' access to credit. The program started in Indonesia with 500 retailers, and it aims to build to 5,000 retailers. The results of the alliance are a technology solution that provides two key benefits. The first of those benefits is wholesaler access to credit. MasterCard is leveraging supply chain data from NFriends and SGBiz's digital procure-to-pay platform and other sources to partner with Finastra and its trade bank customers to automate access to working capital finance. The collaboration will increase the digital data available to assess creditworthiness and to create new models to evaluate. Access to the resulting lines of credit will enable wholesalers to react more quickly to upcoming promotions, to increase their inventory levels, and to build their businesses. The second key benefit of this project is fully digitalized marketing campaigns. Through integrating digital payments and supply chain data with promotions, FMCG trade spend can be allocated more efficiently with better visibility and inclusion of SME retailers. The alliance will leverage nFriend's mobile solution, which optimizes logistics and operations by connecting FMCG companies with wholesalers for placing orders, coordinating deliveries, and monitoring inventory levels to better communicate upcoming promotional efforts between suppliers and wholesalers. So our third topic today is about supporting inclusion, empowering choice through open banking, enabling more access through data, but what about including those who are impacted by disproportionate distribution of wealth because of a history of exclusion? Let me tell you a story of Wole Coaxum. In the late summer of 2014, Wole Coaxum was glued to the television in his Wall Street office. He watched in horror as violent riots broke out in Ferguson, Missouri, after police fatally shot unarmed Black teenager Michael Brown. To Coaxum, who's Black, it was unfathomable to see similar images he grew up watching in documentaries about the civil rights movement and to hear the same conversations about how to solve racial problems. At the time, Wole was head of sales at JP Chase in New York. After spending a year puzzling out how to make a difference, Coaxum left his lengthy career in corporate finance. He joined 4 other partners to incorporate Mobility Capital Finance Inc., also known as Mocafy, a fintech dedicated to providing financial services to suit the specific needs of people of color. Mocafy is based on 2 key insights. Firstly, people of color are vastly underserved in banking, and the current banking system sets up people with little money for failure. In 2019, almost 14% of Black households in the US were unbanked, more than double the number of all American households. And the unbanked population in the US alone is growing at between 5 to 7% a year. According to a 2019 McKinsey study, people of color pay $40,000 in additional banking fees over their lifetime. So Wole decided digital banking would best reach people who often don't have access to banking services. After building Mocafy's mobile banking app, he connected with advocacy groups to get the app to those who most needed it, such as restaurant workers in New York City. And as Mocafy grew, it added tools to help users boost their credit scores, and it gradually began developing courses and educational components. Today, Mocafy has more than 25,000 users who can deposit checks, build up their credit scores, and make payments, all without being crushed by fees. They can also use free ATMs in 5 countries to avoid check cashing shops that charge high fees, and they have access to MasterCard-linked debit cards. Mocafy first connected with MasterCard when Wole included our educational material as part of his platform. In 2018, we joined forces to develop the City Key program to embed banking features in some municipalities' ID cards. People without a typical debit card could use this card instead to open a mobile banking account and access city services. Last year, Mocafy joined the Start Path program to work with cities such as Honolulu, Los Angeles, New York, New Orleans, and Chicago to continue building financial tools for underserved communities. And as part of MasterCard's $500 million commitment to help close the racial wealth gap in the US, MasterCard has also invested $2 million in Mocafy to help address these inequities and to support the company's efforts to provide banking, credit building, and wealth coaching services to the underbanked. As part of the embedded fintech trend, vertical fintech solutions such as Mocafy are genuinely building customer-centric products that will lead to greater inclusion in a post-pandemic world. So in conclusion, as we look beyond COVID, the old rules of engagement no longer apply. We're in a new normal where new rules are needed. The speed of progress is a significant change architect, impacting consumers, companies, and governments alike. In the pre-pandemic digital age, when competitive landscapes transformed gradually, it was hard to recognize the signals in the noise. But in this new era, the pressure to spot changes and respond to market signals is higher than ever. And by focusing on the needs of the consumer and ensuring that the consumer has choice, access, and is included, we're all in a good place to build for the next billion. Thank you so much for having me speak with you today, and I'm very happy to take any questions that you may have.
Thank you very much, Emmy, for that very insightful and fascinating keynote address. Thank you very much indeed. So I will start with a first question from me, if I may. So financial technology does not necessarily enhance financial inclusion. And indeed, we have seen some preliminary data to suggest in some cases, in some countries, digital financial services can actually lead to financial exclusion, especially when consumers do not have a broadband access or have sufficient level of financial literacy and digital literacy. So how can we ensure that digital financial services can overcome these challenges and to be truly inclusive?
So I think that's a really important point, Brian, that inadvertently digital can leave some people behind where they don't have access. For me, actually, what I see in the work that I do in the fintech space and working with fintech companies is that new players, new companies are often driven by a need to accelerate change, by a want to accelerate change. And actually, it's those mission-driven companies that I think are helping to secure a future where people can be included. I spoke there about Mocafy. We've also been working with a company in the US called Goal Setter, which is focused on family education. So building education from very young ages to ensure that the children of families that might have historically been excluded can be included. We're also talking to a fintech in the UK that's looking at using open banking solutions to think about how open banking can address situations where branches are closing down. So how do you still provide access in rural areas where there are no branches, but by providing a new alternative network in an unbranched environment? So, you know, I think that we need to acknowledge the challenges that digital can bring to excluded individuals. And I think that we need to focus on the founders of new opportunities who are really thinking about holistic solutions that include more people.
Thank you very much. So next question is from the floor, from you. So the question is, what do you think about MasterCard and the fintech you've been helping and investing can collaborate with traditional banks? So that sort of a private-private partnership can increase access to those unbanked or underbanked.
It's a great question. I think, 10 years ago, the key word around fintech was disruption. There was an expectation that fintech was going to come along and completely demolish what already exists. I think what we've learned over the last 10 years is that that's not correct. That's not how things have played out. The partnership word is the one that we have heard increasingly over the last several years. New players bring certain things. They bring agility. They bring the ability to move fast because they have small, agile teams that are very much focused on the technology. But the traditional players also bring really important facets to the party. They bring an understanding of the regulatory landscape, which of course is so incredibly important. They bring an understanding of compliance and what it really takes to work in that way. They bring an existing network and brand of trust to the party. So from a MasterCard point of view, what we have really been trying to do is find those connection points between the new players and the existing players, that existing ecosystem, and create an ecosystem of what we call fintech innovators, whether those are legacy players or whether those are new entrants, and to find the opportunities to build those solutions, those alliances, those new products together.
Thank you. Another question from the floor from Min, who said, in some developing countries, they have a high level of household debt. How can we strike a balance between financial inclusion and micro household level financial sustainability?
So for me, I think that is about building the opportunity for alternative approaches to lending that enable people to borrow where they might not have previously had access to credit scores. By building that out as a piece of the infrastructure, as a foundation, that means that people don't have to turn to those solutions that they're facing today that can bring with them very high interest rates and cause them to find themselves into spiraling scenarios of debt that are incredibly hard for them to get out of. Responsible lending and finding ways to bring responsible lending products to the market is absolutely key. And for me, that's about building different approaches to providing credit scores and enabling that alternative approach.
Thank you. I think we're right on time. So may I take this opportunity to thank you very much, Amy, for your excellent presentation and for taking the time to answer some of the questions. Really grateful. So on that note, I'll hand back to John. Thank you.
Thank you very much, Brian. Sorry, thank you very much, Brian. Thank you, Amy, for these very important insights, which sets the scene very well for the next session. The first presenter will be Nidia Remalina, who's a research associate at the Center for AI and Data Governance at Singapore Management University, and she will present her work entitled Towards a Data-Driven Financial System, the Impact of COVID-19. So Nidia, please go ahead. You'll have 20 minutes, and I will remind you a couple of minutes beforehand when you should wrap up. So go ahead.
Thank you so much, John. And thanks to everyone that made this conference possible. It's a pleasure to be here and an honor to have the opportunity to share with you all about these topics. And I'm very happy to hear Amy's presentation, because some of what she mentioned about the roles of regulators, policymakers, and what we need to tackle as challenges in the future in the post-pandemic world is something that I also try to address in the paper. Basically, this paper tells the story about how the financial system was working towards a data-driven business before the pandemic, as we all know, but how that changed, how this path was accelerated, and this process was accelerated in some topics during the pandemic, and some of the challenges that regulators will need to tackle, probably in some cases in a different way, in other cases with a more accelerated pace. So I will talk about this by the end of the presentation. Based on this, I will divide these 20 minutes in 4 parts, basically, more 3. The 4th is just the conclusions. But first, I will briefly mention how the financial services industry was conducting and was doing this data revolution within the sector. Secondly, the evolution of data-driven finance during the pandemic, how that happened, and some specific cases and numbers of this situation. Thirdly, I will talk about these challenges that I just mentioned, and how can regulators, policymakers, academics, and the industry itself contribute to the future of data-driven financial services in the post-pandemic in a safe way, ensuring financial stability and consumer protection and all other regulatory objectives of the financial services industry. So first, the data revolution in financial services industry. We all know the fourth industrial revolution. It was affecting every industry, and the financial services was one of those that was ahead in the game with these new competitors and even traditional financial institutions conducting these strategies on digital transformation way before the pandemic. So most financial institutions and even these new actors have nowadays strategies at the board level or at the top management level with regards to digital transformation. By 2019, 90% of financial services firms are making some sort of inroads towards this process. More than 21% are developing the digital transformation strategy as their top digital priority, according to Gartner. Gartner is a think tank that is very famous because they try to measure the emerging technologies and their impact on different industries, the financial services being one of them. A top driver in these strategies, and some of them where consulted for the paper, and Gardner also talks about this, is data monetization. So the data-driven business that I'm referring to in the paper is about a new business model that goes along and goes at the same time in financial services institutions that allows these companies to exploit the data they control, basically, to monetize this data. And this is a priority and a top driver in these digital transformation strategies. New data operating model focused on the role of data in the decision-making process is another key feature of this data revolution in the financial services industry. This new operating model is related to what I was just mentioning about data monetization, and basically relies on the use of different emerging technologies such as Internet of Things, artificial intelligence, machine learning, deep learning, cloud computing, quantum computing, and as Amy mentioned before, and she emphasized, open banking, and in some, or open finance, how it is called in some jurisdictions nowadays. This has some benefits. We have just heard about some of them: efficiency, more competition. This can enhance customer experience in some cases, but not. This is not a generalized or necessarily inherent to digital transformation, but in some cases, this can contribute to financial inclusion in some jurisdictions, but it has some challenges, and these challenges have been recognized before by policymakers, international organizations, international standard setting bodies. So the idea is to see how this has evolved during the pandemic, and how these challenges that have been studied even before the pandemic in this roadmap to the digital transformation to the financial services industry are going to change, and how we need to tackle them in the post-pandemic world. I will divide these changes occurred during the pandemic in different topics. First, I will talk about the data-driven lending to help small and medium enterprises. We all know, and we have heard about the importance of small, medium enterprises. They represent about 90% of businesses and more than 50% of employment worldwide. They contribute up to 40% of national income in emerging economies, and they create 7 out of 10 jobs, according to the World Bank, a study published in 2020. That's why SMEs and MSMEs were one of the focus of most of some of the interventions in many jurisdictions that try to help and tackle these challenges that arise during the pandemic because of the economic crisis associated with the lockdowns and the economic recovery that every jurisdiction needs to work on in the post-pandemic world. So that is definitely a challenge. In some countries, for example, in China, traditional banks have even been criticized because of their slow response to COVID-19, particularly in relation to lending issues. So that's why many international setting bodies, that's one of the reasons why international setting bodies and regulators around the world try to interpret in different ways, or try to tell these markets that, for example, they could use some of the capital buffers to help more the economy in this path towards recovery. How did the market respond? Because I want to focus more not on what regulators necessarily did for helping SMEs, but what the digital transformation helped in this regard. Some of these responses are documented in the paper. First, non-bank online lenders are participating in lending programs. This is the case of the United States with the Paycheck Protection Program, in which fintech companies that are not traditional banks are participating in the disbursement of loans in this program. And it's very interesting to see, for example, the application to this program that PayPal published. They published the letter they sent to regulators, and other companies such as Square did the same. They basically argue what they have a competitive edge, a competitive advantage because of their data-driven business and their data-driven lending type of business in a specific, how they have this competitive advantage against traditional banks and how they can contribute to disburse these loans in an efficient way, in an efficient manner, by using AI credit scoring models. Not necessarily in practice, we will see that this is going to be one of the challenges, necessarily in a better way in practice, in comparison to what the traditional financial system does, because this has other challenges associated with the use of AI in lending models. We will see that type of challenge in the last part of the presentation. Data-driven lending has the potential to show how beneficial these new businesses can be for economic recovery. So we still need to see what happens after the pandemic and how can we measure that success that they are promising. Alternative lending companies and crowdfunding platforms are scrambling in some jurisdictions to raise funds and stave off bankruptcy as they face a wave of bad loans. This is the example of this is Malaysia. In Malaysia, this situation happened with the crowd lending platforms. Partnerships between traditional players and fintech companies to help SMEs was something that was witnessed in Latin America. Some traditional players are partnering with merchants and fintech companies to broaden the use of QR codes, for example. That was something that in Latin America was not necessarily adopted widely before the pandemic, and the pandemic allowed some countries such as Colombia to adopt this in a broader way. Partnerships between traditional banks and the retail sector. Someone asked in the previous presentation, the keynote speech, about how some industries can partner, or how the traditional financial system or the financial system can contribute with other industries to respond to these needs. And one example of this is Asia, and particularly Singapore and the food and beverage industry. In this case, for example, a bank in Singapore worked with the Restaurant Association of Singapore because they were losing lots of revenues. And to address this issue, DBS partnered, a bank in Singapore partnered with the government of Singapore and two homegrown fintech companies, Odal and Firstcom, to roll out a digital relief package for this particular industry. Specifically, they enabled these businesses to set up an online food ordering site in just 3 days with much reduced delivery rates. And as a result, the bank enabled these small and medium enterprises to quickly create additional online channels in order to increase their revenue. So that's just one example how the traditional financial system and regulators can contribute by partnering with other industries. Financial inclusion, what has happened in terms of financial inclusion? In some jurisdictions, the pandemic has allowed, I just mentioned the case of Colombia, some merchants to enter in the space of digital transactions and to receive payments digitally. That was triggered by the lockdowns and the pandemic. So basically the need of markets allowed them to move into that direction. In some jurisdictions, actually the World Economic Forum has published some articles saying that this was witnessed and this was evidenced before in the SARS pandemic in the early 2000s that happened in China with this epidemic, and e-commerce and digital payments were partially developed in this jurisdiction because of this trigger. That was one of the causes of this, of how they explode, and digital payments were broadly adopted in the country. Going digital and the user experience. The Financial Action Task Force, actually someone also mentioned this in the chat box. They were asking about what the Financial Action Task Force is doing in this regard. They issued a document about the risk-based approach and how that approach can be applicable to the circumstances under the pandemic, because they want to encourage particularly emerging economies to go totally or try to go in totally digital in terms of onboarding and simplify customer due diligence to facilitate the inclusion of some merchants and SMEs, etc. So they issued a report and a document giving some guidelines about how this could be achievable in some jurisdictions where, for example, digital identity infrastructure doesn't exist. So this obviously does not facilitate things for traditional financial players and the new competitors of the fintech industry that want to offer products that are totally digital since the onboarding process. So the pandemic is encouraging even regulators and these international setting bodies to think about new ways of doing customer due diligence and tackle money laundering issues in the digital space. An additional thing about user experience is that banks have been used during the pandemic and after the pandemic more chatbots. And for example, a study conducted by a fintech called Cbot showed that in Turkey and in the US, the number of users and messages has increased during the outbreak and after COVID-19. So that is important because the use of artificial intelligence in other products, not only in lending products, is being used more frequently because of these online and digital interactions with customers. Central bank digital currency, it's another topic which discussion was accelerated in part because of the pandemic. Other reasons about this is some private companies announcing that they want to launch central bank digital currency. So some jurisdictions are obviously worried about how this can affect the use of cash in those specific jurisdictions if these big techs become the main player offering stable coins, for example. So they probably need to offer another alternative controlled by central banks, which would be the central bank digital currencies. But without a doubt, the pandemic was another thing that triggered the discussions around central bank digital currencies, and this is recognized in some of the reports recently issued, particularly in 2020, by the Bank for International Settlements. What are the challenges ahead? Because I'm conscious of the time. Thank you, Jan. The challenges ahead, basically, that I just mentioned in the paper, and I provide some alternatives to how to tackle them, are in inclusive recovery through artificial intelligence and data analytics. Basically, I propose to move away and go beyond talking about these principle guidelines and this principle-based approach to artificial intelligence, particularly if it's voluntary. Perhaps we need to think about another alternatives in lending markets. For example, I propose in another paper to enhance the exposed control of AI-based credit scoring models. So the second challenge that I mentioned is online lenders and digital payments vulnerability, and perhaps in some jurisdictions it's important to rethink and modernize what we regulate in digital payments and online lending, and how we are addressing systemic risk in that specific market and how that can affect the entire financial system. Next generation loan sharks, this is associated with the ethical challenges of the use of artificial intelligence. And in some countries, in India and Philippines, and some countries in Africa, some studies demonstrate and showed that these online lenders can contribute to financial inclusion, but at the same time can charge high interest rates and perform practices that make people dependent on this platform. So these ethical issues and on top of that, discrimination biases because of the use of AI is something that we need to address from a regulatory perspective. From open banking to open data, to think about perhaps beyond exposing data that the banks and traditional financial institutions control, and go beyond that and think about other data repositories that are very valuable for financial services products. Data challenges for regulatory agencies, the use of RegTech is something that in the digital space is much needed, and regulators need to move ahead and implement new technologies also to supervise markets, and the role of standard setting bodies in terms of international cooperation and the balance, how regulators on the local level can balance different regulatory objectives. The standard setting bodies should give more guidance in that regard for particular issues that are present in the digital transformation of the financial services industry. I will end with this. Thank you, John, for giving me the floor, and I guess I will pass the floor to you. Thank you so much.
Thank you
and
very
I'm
much,
looking
Lydia.
forward to hearing the comments and the questions from the attendees. Thank you.
Thank you very much. So first of all, let me just encourage participants to ask questions either in the chat box or the Q&A box. And before we open the Q&A, I would like to invite Lin, who is the discussant of this paper. Lin is an assistant professor in law at the National University of Singapore, and she will discuss the paper over the next 10 minutes, and then we will have a Q&A session for 10 minutes. So please, Lin, go ahead.
Thank you, John. Thank you, John, and thank you, Nadia. I really enjoy your paper and presentation. So overall, I think this presentation and the article is an extremely interesting and timely look at the post-pandemic financial world. It also displays commendable breadth, covering developments in the developed and developing world. And the sources used are also highly relevant and pertinent to the issue. And I really benefit a lot from reading the papers and also listening to your presentation. As I'm an academic, although I practiced before a long time ago, hopefully I will be able to provide some meaningful comments for improvement of the papers from academic perspective. First is about the research question. I'm still wondering what is your main research question or the research puzzle in this paper. So based on the title, if the research question is what is the impact of COVID-19 in a data-driven financial system, I think the author has provided very useful answers to it. And if the answer, if the question is how a data-driven financial system has developed, and I think the author has also done a great job on that. But if the focus is on the use of data in the financial system, I think there are something need to be further explained or clarified, especially on one principal controversy, that is data protection and privacy. So if you include this question as to the use of data in financial system, perhaps you could have some mentioning of this. It would be more helpful. And also, if the question is how do we solve the problems or risk and challenges of a data-driven financial system, I think more answers can be provided to it in your future revised draft. Especially the paper concludes that an adequate balance of different regulatory objectives will be crucial for a sustainable recovery in a post-pandemic financial industry. However, I'm still wonder what exactly are these different regulatory objectives are and how they might conflict. And I assume that different countries have different economic infrastructure and economic conditions. So perhaps different countries would also have to adjust that regulatory objective when they design a data-based financial system moving forward. So I think the central thesis could be developed further a little bit. The second point is the paper mentions data, but appears to combine or conflate the use of data and the use of technology together. There are different kinds of technology in the fintech sector. And so you can focus just one specific technology in a specific area, such as the AI technology or blockchain technology, or a platform economy. And perhaps you can develop many more papers based on different applications of different types of technologies in a specific fintech sector. And also questions about the potential misuse of data and the use of data resulting in suboptimal effects from a user or regulator also appears to be a key issue in this space. And perhaps you can mention a little bit more to it. There are some assumptions about the technology in the paper, which could be raised and explained upfront for greater clarity in the paper. For example, the paper suggestions to remodel traditional credit scoring under section 3.1 left me with some questions. Could organic factors like the potential impact of the pandemic actually be modeled meaningfully? And should they, if doing so, opens the door for other organic factors to be modeled as well? Further, these suggestions can be strengthened by highlighting how banks do not formally consider the impact of the pandemic on potential lenders' credit scores, if this is actually the case, and how this lack of inclusivity is addressed by the suggestions of a dynamic credit decisioning framework. Third, there are some general statements that might need to be clarified a bit further. For example, one of the suggestions is for international debate in this space in order to prevent a financial crisis arising from the identified risk. I think this suggestion is commendable, and it would have been more persuasive to examine how this proposal will solve some of the identified challenges. For example, the point on the fragmentation of regulatory approaches under Section 2.3. This would have also allowed for the point on fragmentation, which I felt can be addressed further or fresh out. Also, the paper recognized that these similar regulatory regimes have been extremely challenging for digital lenders. I think there are more explanations as to how the Financial Action Task Force, FATF, measures, which were mentioned in the same paragraph, could address. Because no mention was made of whether these FATF's measures are binding on countries or merely persuasive. So tying this observation together with the proposal at the end of for financial international debate would have been a good way to develop these 2 points. Another assumption is that technology engender opacity, with the support for this being the widespread use of opaque AI models and the lack of interpretability or auditability of AI. I'm not so sure whether it's true for all types of technologies, especially blockchain, which is technology underpinning central bank digital currencies, allow for immutable and traceable audit trail. That might increase transparency as well. So I think a more nuanced discussion on different types of technology in different kinds of fintech applications would be helpful. So it could also be further explained how and why the CBDCs, the central bank digital currencies, are seen as the most convenient tool to translate central banks' zero and negative interest rate policy into commercial banks. The source referred in the footnote shall some light on it. Hope you can just further clarify on it. Perhaps also looking into this claim further could lead to a more crucial analysis on the type around CBDS. And lastly, just some minor point. Alibaba is Hangzhou based, but not Shenzhen based. Yeah. And finally, it's about the structure of the paper. I think the second portion of the paper could have been better structured. Perhaps more could be done to link the examples given with broad thematic developments in the use of technology in finance. And all in all, I think it's extremely relevant and compelling paper with great potential, just with a little tweak to the clarity and development of the paper's thesis. I'm sure it will contribute significantly to the current literature on financial technology. Is also of great implications to practice. So congratulations, Nadia, and thank you so much for giving me the chance to read and enjoy your presentation. Thank you.
Thank you very much, Lynn. So before we take a few questions, I would like to ask Nadia if she would like to respond to the discussant.
Just so we have time for the Q&A, I just want to say thank you so much, Lin. As you know, I was very much looking forward to receiving your feedback. It is very valuable and it will enrich the next versions of this research project. And definitely I want to expand on some of the issues that you already pointed out. However, when I was writing this paper in particular, I tried to provide the overview of what was happening during the pandemic and just mention some of the challenges, because each one of them and each one of the technologies has its particular challenges as well. As you mentioned, blockchain has other problems than the use of AI, than other things related to the digital transformation of the financial services industry. So each one of the topics could be an entirely separated paper. So that's why I want to expand on some of the things that you mentioned. I'm conscious that is needed for this version, but at the same time, I'm also working on those particular issues in separate pieces. Thank you so much.
Okay, thank you very much. So there are a few questions in the Q&A box, but maybe I could ask a question before we look at those questions. So you mentioned in the presentation that the pandemic has led to an increased rate of partnership between banks and fintechs. Now, I'd be interested to find out if there are differences in regulatory challenges depending on the rate of advancement in fintech in particular countries and differences across countries. So is there any evidence that there are differences in regulatory challenges depending on the scale of fintech in different countries?
Definitely. If, for example, you compare some developed economies with some developing economies, in developing economies in some countries, for example, in Latin America, digital payments and digital payment service providers are not yet regulated in most jurisdictions. So these fintech companies are entering in the payment system space, but they are not being supervised or they are not being required to have a license in most of these developing economies, yet they are partnering with traditional financial institutions. So even in some sandboxes I've seen in these developing economies, financial institutions partnering with these unsupervised and unlicensed fintech companies that are just traditional payment service providers, but not yet regulated in that specific jurisdiction. And the supervisor and the financial regulator is expecting the traditional financial institutions to bear the risks associated with the activity that that both companies are performing as a result of this partnership, as the outcome of this partnership. So the challenges in those developing economies, in those jurisdictions, are going to be different than the ones that we've seen in Singapore, for example, in which it's common to see financial institutions, or in Europe, financial institutions partnering with fintechs that provide services such as e-wallets or other type of services associated with digital payments, but they are licensed, they are regulated. We have a modernized, and these developed economies have a modernized approach and modernized regulatory framework for the digital payments ecosystem since years ago. The discussion is definitely different, going in different paces, and therefore the challenges would be different. So it's important that regulators in developing economies participate in international forums and international discussions of topics such as central bank digital currencies and the new reforms on the new proposals to reform the PSD2 in the digital finance package in the European Union. But at the same time, they need to catch up with regulatory developments, because there's no doubt that some of these activities that are being performed in an unlicensed way in some of these jurisdictions should be regulated somehow.
Okay, thank you. There's another question about the MSME sector. You can see it in the Q&A box. Basically, as everybody knows, this sector was particularly hard hit by COVID-19, and one of the participants has highlighted that the informality in this sector may impede somewhat the extent to which fintech can improve the performance in the sector. So is there any insight or any comments that you would have on that?
Well, the informality is definitely a problem that goes beyond what financial regulation and financial regulators can do in that space. But looking at these partnerships that I saw in some countries, for example, the particular example in Singapore with traditional financial institutions partnering with some merchants, some MSMEs and SMEs and regulators and fintech companies, not only because of they wanted to provide digital payment type of services or financial products to these companies necessarily, but the first stage of this partnership was to basically help them to navigate the world of moving from these cash-only transactions, the payments only in cash, receiving only payments in cash, to going into the formal financial sector and with digital payments, using digital payments. In that path, in that process, I found interesting that perhaps in some other countries, traditional financial institutions, regulators with conscious of the need of entering these MSMEs into the formal world can perhaps design a kind of sandbox or just a path to test how these MSMEs can navigate towards that path to become or to come into the formal the formal transactional world and adopt digital payments. If we are talking about adopting digital payments, just as an example, that could be one option, just using the financial sector as a tool to help these MSMEs to come into the formality, not necessarily at this first stage to sell them financial products and enter them into digital payments. But first, try to design a path to accommodate them into the formal world. But that is definitely a problem that goes beyond financial regulation. But the result is going to be beneficial for everyone. And that's why I think financial institutions could be interested in participating in this type of initiatives.
Yeah, I mean, there's another question there, which talks about cybercrime. And this also links back to the regulation situation in terms of finding the right balance between regulation and letting the market work. So I don't think you touched upon that too much in your paper. So is there anything that you could say about finding the right balance between regulation and allowing fintech to perform at its utmost?
That's a very interesting question, because somehow we tend to think that regulation is against innovation, or that both things go into different sides of the spectrum, and not necessarily. For example, in some developing economies in which crypto exchanges want to operate but are not licensed yet, or there is no regulatory framework for them to operate, these market participants are the ones asking the regulators to provide them with a framework to operate in those markets. They are ready to start, or they are even operating with this legal uncertainty because they don't have a license, but they have these international recommendations from the Financial Action Task Force saying that local regulators should provide them with a license and oblige them to comply with the travel rule, etc. But local regulators haven't taken steps towards that. So even market participants that are innovating in some markets in the financial services industry are asking for legal certainty and the development within the regulatory space and in regulatory frameworks. So it depends on the specific case, but not necessarily regulation is something that is against innovation. In some other fields, for example, the use of AI and some other technologies, perhaps if we are talking about the use of AI for lending, and for changing the credit scoring models, we need a different approach. We cannot regulate too stringent in the first stage because we need the first approach taken internationally was to recommend some guidelines and some principles that are voluntarily adopted by market participants. After a couple of years with that approach, some jurisdictions are starting to say perhaps we need to move forward and think about other ways of controlling what market participants are doing with the use of AI and the consequences, unintended consequences of the use of AI. So it would depend on the specific innovation and the technology that we're talking about, but I would like to say that not necessarily regulation always is against innovation. Sometimes it could be the driver to innovate.
That's a very good point. Anyway, Nydia, thank you very much for your excellent and comprehensive answers to the questions and your very good presentation. We're now going to move to paper number 2 of today, which will be by Antonis Ballas, who's a PhD fellow at Athens University of Economics and Business in Greece. And his paper is on COVID-19 impact on cryptocurrencies on traditional markets, a difference in difference approach. So Antonis, please go ahead. Are you there?
Yes, thank you very much,
yes.
John. Good morning from Greece. Let me share my screen with you. I hope that now everyone can see my screen.
Yes, it's
excellent. Let me begin by thanking you profusely for this opportunity. In our lab, we have a process by which, as academics, we state hypotheses, and our colleagues have a holy duty of shooting them down. And any hypothesis that survives that process has some degree of evolutionary fitness. Not that it is the truth, but that is likely approaching the truth. That is more or less how this analysis came to realization. Before we begin, let me start with some basic and intrinsic characteristics of cryptocurrencies. Cryptocurrencies are digital currencies that rely on cryptographic methods for the security of the transactions and the creation of new currency units. Moreover, cryptocurrencies, in most cases, are issued and controlled by the users themselves and not by financial institutions like traditional currencies do. In recent years, there has been a proliferation of new coins, and more than 2,000 cryptocurrencies have occurred, with the first one and the most popular up to date, Bitcoin, making its appearance back in 2008. However, in the economic literature, the study of cryptocurrencies has only recently received the necessary attention. Okay. The intrinsic characteristics of cryptocurrencies that differentiate them from various other traditional financial assets give rise to the question of whether, in the presence of an adverse exogenous shock, such as the COVID-19 pandemic, traditional assets and cryptocurrencies have the tendency to move in tandem or follow dissimilar trajectories. The present study sets out to investigate the impact of COVID-19 on a set of important market metrics such as turnover, capitalization, and return of the traditional and cryptocurrency markets. However, we are not interested in measuring any potential effects on each market individually, but rather explore whether there are any differences in the relative time trajectories after the outbreak of the first wave of the pandemic. The data set that we use is in a form of a panel data set, which consists of 21 traditional indices, mainly major stock markets, and 21 cryptocurrencies for which volume in terms of trade value, capitalization levels, and closing prices were collected daily. We furthermore selected 2 equal-sized daily time spans of 6 months each, defined before and after the formal declaration of the pandemic by the World Health Organization. A visual inspection of the overall paths is given in figures 5.1. What figure 5.1 actually does is to depict total volume for both traditional market indices and cryptocurrencies in the pre and post COVID-19 eras. Now, looking into the overall averages depicted here, we can see that in terms of volume, traditional markets, as expected, stand well above cryptocurrencies. However, in the post-COVID-19 era, we see the possible potential of the cryptocurrency market, since the existing gap between the two markets in the pre-COVID-19 era has shrunk after the breakout of the pandemic. Accordingly, figures 5.2 and in the next slide 5.3 provide us with similar information regarding total market capitalization and mean price return. Based on this, we reach a tentative conclusion that possibly there has been a significant difference among the two markets between the two periods discussed in this analysis. However, a formal answer to this can only be given within an econometric framework, which in our case will be given by a difference in differences, a DID model, which is deemed appropriate for such an analysis. Interestingly, the first scientific study using explicitly a DID approach is the study by Snow about the cholera pandemic of 1846-1860. Snow was interested in the question of whether cholera was transmitted by bad air or bad water. As a testing condition, he utilized a change in the water supply in the district of Soho in London. In that way, the first DID estimation performed derived from another significant event concerning public health. Now, the main idea behind the DID methodology is the combination of insights deriving from cross-sectional treatment control comparisons and before-after analysis. One of the simplest application of this methodology is through a setup where the outcomes of two different groups are observed throughout two time periods, a time period before treatment and the time period after the treatment. The treatment group is exposed to a treatment or policy or external event or anything, or an exogenous shock, as in this case, in the second period, but not in the first period. The control group now is not exposed to the treatment during either period. This is the basis of the notion of the DID model. Now, in repeated cross sections, we can write the model for a generic member of any of the groups as depicted in this slide. Now, the coefficient of interest, delta, multiplies the interaction term, which is the same as a dummy variable equal to 1 for those observations in the treatment group in the second period. Okay, based on the previous discussion, we utilized the following specification for each of the three variables under scrutiny in this study, where COVID-19 is a dummy variable for time period, taking the value 0 for the pre-COVID-19 era and 1 for the post-COVID-19 era. Accordingly, the dummy variable asset attains the value 0 for traditional assets and 1 for cryptocurrencies. The coefficients of interest, the three deltas that we see in these three specifications, capture the impact of the interaction term, which is asset multiplied with COVID-19, which identifies the post-COVID-19 impact on cryptocurrencies. Okay, Before we embark on the DID estimation, we conducted panel unit root tests, several of them, on all of our variables to ensure their stationarity as reported in table 5.3. Based on the panel unit root tests, we conclude that the variables are stationary, and therefore we can proceed with the DID estimation. Now, table 5.4 reports the results for the above mentioned models utilizing the GLS random effects estimator using bootstrap standard errors. Now, for the first dependent variable, we find that the main parameter of interest, delta 1, is positive 0.37 and statistically significant at the 1% level of significance. This finding indicates a positive effect in the volume of cryptocurrencies when compared to the one of the traditional markets, meaning that there is a statistically significant smaller gap between them in the post-COVID-19 era. What essentially this means in financial terms is that in the post-COVID-19 era, there is heavier trading in cryptocurrencies than in the traditional assets of the study. Moving on now to the second dependent variable, the main parameter delta 2 is found to be positive and statistically insignificant, suggesting that in the post-COVID-19 era, there has been noted no significant impact in the pre-existing gap between the market capitalization of cryptocurrencies and the one of traditional markets. Now, finally, looking into the third variable under study, where price return is utilized and has a role of the variable of interest, let's say, parameter delta 3 is found positive once more, 0.008, and significant at the 1% level of statistical significance, indicating once again a smaller gap between the traditional assets and the cryptocurrencies of this study during the post-COVID-19 era. My next two slides summarize what I have been discussing in the table. So I will offer a few seconds for you to look it up for any possible questions next. Essentially, they contain what I have already discussed looking at the table about the three parameters of interest and what they actually indicate regarding our research question. And in order to be on time and have more time for questions, I will conclude my brief explanation of this paper. Overall, the results that we have seen corroborate our initial tentative conclusions that there are, in fact, discernible differences among the two markets' relative trajectories after the outbreak of the first wave of the pandemic. According to our empirical findings, as manifested via the time paths of volume and price return, we document a closing of the gap between the cryptocurrency market and the traditional assets in the post-COVID-19 era. This possibly can be explained as a significant sign of the maturity signs that the cryptocurrency market has been starting to show and to develop. Now, a fruitful extension for future research, other than containing in the study the other two waves that came after the first wave of the pandemic, to see how the possible results may change. Another extension would be the investigation of the root causes of this phenomenon by paying special attention to the apparent heterogeneous profiles of traditional assets and cryptocurrencies, as well as the perception of this by investors. Thank you very much. I am open to any questions, so I will be returning the floor back to you, John.
Thank you, Antonis. Very interesting presentation. Before we have the Q&A session for this paper, we will have a discussion of the paper by Professor Sayuri Shirai of Keio University here in Japan.
Yes.
So Professor Shirai, please go ahead. You have a maximum of 10 minutes and then we will have the Q&A. Thank you.
Yes. Let me share screen. Okay. Can you see the screen?
Yes.
Okay, so I'd like to make a comment on this interesting paper. I think this paper is very interesting because when we talk about cryptocurrency, most of the papers we compare with the between cryptocurrency and fiat currency, and then usually we ask whether the cryptocurrency function like a money. But this paper is focusing on the cryptocurrency as a financial asset, and compare with the traditional market, which means stocks market in this case. So in that sense, I think this paper is quite new. And so the data look at the 6 months daily data and before, and 6 months before and 6 months after COVID-19. So it covers up to the June last year. And looking at the 21 stock indices and 21 top cryptocurrencies, and then I took the approach of this difference and then try to check whether these two markets had different responses to the COVID-19. So just to make a quick comparison between traditional stock market and then cryptocurrency, the stock market has a physical representation, but cryptocurrency does not have physical representation. And the stock market is highly regulated by the authority, but cryptocurrency, there is a limited regulation and no association with the authorities. This paper, the result of this empirical analysis is showing the gap between cryptocurrency and the stock market still exists in terms of turnover, capitalization, and price returns. However, the paper showed the gap shrunk after COVID-19 pandemics, namely, especially turnover and the price returns, the gap between cryptocurrency market and stock market shrunk. So that was the essence of this paper. I have 3 questions to Antonis. The first question is that the paper covered up to June 2020. And then during this period, especially March and April, stock prices dropped much more deeply than cryptocurrencies. And the decline in the stock prices in March and April was not only deep, but more persistent compared to the cryptocurrency market. So therefore, probably because of this different pattern contributed to the narrowing the gap between cryptocurrency and the stock market. So then the question is, what if the sample period is extended up to say the end of 2020? The question is whether you still get the same result. Because when you look at the movement of stock prices and the cryptocurrency, there are various the relationships are changing over period. For example, from May to October, thanks to the massive monetary easing, the stock prices started to rise quite rapidly. And looks like the pace of stock prices was the pace of increase in stock prices was faster than the pace of increase in cryptocurrency. But after October 2020, all of a sudden, the stock price, cryptocurrency prices started to rise very sharply. And then they rose more deep, and they rose much faster than stock prices. So I think depending on the period you choose, the result could be different. So that is my first question to your papers. So this is just a quick, simple chart, and which shows probably the relationship between the pace of increase in stock prices and cryptocurrency change, depending on the period you look at. The second question is that you look at also like price returns, but you included stable currency. For example, USDT is third or fourth most popular cryptocurrency, but and then also in the case of cryptocurrency, Bitcoin dominates, right? The Bitcoin dominates 80%. So when the situation is such a, when the cryptocurrency has such kind of market structure, I'm not sure how important to compare 12 cryptocurrency. So first, the cryptocurrency, Bitcoin completely dominate 80%. And so inclusion of other currencies may not be so important. So this is like first question. Second, stablecoin, as you know, there's no price returns. So if you are talking about price return, it's a bit difficult to understand why you need to include stable coins. So and also this issuance of stable coin is capped at the availability of fiat currency like US dollars, because as you know, stable coin is issued against fiat currency like US dollars as collateral. So this issuance is set by the availability of dollars by users, and also price is fixed. So I'm not sure whether stable coins should be included in this analysis. So this is my second question. The third question is probably when we look at this relationship between stock prices and cryptocurrency, we may also have to check the changes in investors' behavior. For example, as I said, from around October last year to end of December last year, there was a sharp increase in cryptocurrency, and that is quite well known. It is related to the decline in US dollar index, because during this time, US dollar was dropping. So the value of fiat currency, most important US dollar prices are dropping. And there is so much money as a result of monetary easing, too much excess liquidity, but the US stock prices are also going up. So some investors decided to invest in the cryptocurrency as a hedge asset. So that was one of the main factors contributing to the demand for the higher demand for cryptocurrency. But looks like from January this year, and a lot of investors started to jump into cryptocurrency for speculative reason. So anyway, I think this kind of price behavior also it will be useful if we can look at the behavior of investors. So this is one example. The red color shows US dollar index. So decline means depreciation of US dollars. And that happened very sharply, especially in the second half of last year. And then Bitcoin price and other cryptocurrency price went up. So this was sort of the investor took as a hedge for the declining fiat currency values. Okay, that's all. Thank you.
Thank you very much, Professor Shirai. Very interesting discussion and some very good points made. I would like to give Antonis the opportunity to briefly respond, and then we will have the Q&A round. I can already see some hands raised, so please be quite brief if you can in responding. Antonis, go ahead.
Yes, thank you very much, John. Thank you, Professor Shirai, for all of your comments are quite constructive. And actually, to be honest, they're all comments that we have been looking on answering on the second part of this analysis. What we have seen from the preliminary results in the second part of this analysis, where we have included the second and the third wave of the pandemic. So our current analysis reaches the period of the end of February 2021. We see that in the second period of the pandemic, we see that the gap, I'm talking about the most important metric that we have used, which was volume, which showed the biggest differences, remain stable. But after October and the third wave of the pandemic, along with the surge of the cryptocurrency market, which multiplied many times, we see that the price of Bitcoin went from $5,000 back in June to almost $60,000. We see this difference, this gap shrinking even more. Another concern, as you have stated, was that the dominance of Bitcoin in the market is quite severe. Depending on the period, we have a mean of its dominance around 65%. What we wanted to do was to reach a level of 90%, covering 90% of the market. That's why we included the rest of the coins. The matter of stable coins and how they are attached to the value of dollar, it's something that also creates us a headache, if I can say, but we have included them in this first analysis purely on the merit that how the market capitalized, in that the fact that they are listed in the top 20 market capitalization cryptocurrency. So we didn't want to manipulate this series of cryptocurrencies. Finally, the next metric that we try to incorporate on this DID analysis, and as you have showed with, I think, one of your last graphs, is quite important. We try to incorporate an index in order to capture the herding behavior that does exist in the cryptocurrency market, and the fears index, which will capture to the sentiment, which is a sentiment index, in order to capture the investors' behavior, so we can have, in order to understand why all this is happening. Because right now, the only thing that we have seen is to observe a phenomenon that the difference has shrunk. Now we're looking into why. Maybe it was coincidental, maybe everything will go back in place how it was before. So we need to answer the why. I hope I was brief. John, thank you very much again for your comments.
No, thanks, Antonis. Brief, but also comprehensive. So thank you very much. So we'll now turn to the floor. I see that Peter Morgan has a hand raised. Peter, please go ahead.
Yes, thanks very much. First, I would question why it's called difference in difference analysis, because there doesn't seem to be any control group. Both the conventional assets and the crypto assets were exposed to the same shock. So all we're saying is that the reactions were different for the two kinds of assets, and I think that poses the obvious interesting question, which is why that difference happened. And I think it would be useful to bring in perhaps some control variables. Certainly, one would expect stock prices to react to various kinds of macroeconomic variables, whereas probably crypto assets wouldn't, because they don't have the same kind of connection with real economies. But I think that's the interesting question: is why did they react differently?
Thank you very much for your comments. Actually, as I have said, in this analysis, we used the notion of DID analysis. We take the DID analysis kind of loosely, in a sense that in this kind of scenarios, you cannot have a group of variables that stays unaffected. The way that the reason why we have set as a control variable the traditional markets and as a treatment variable cryptocurrencies is that due to the significant difference of size of regulation that does exist between these two kind of assets. The one has fundamentals behind it, the other one exhibits no fundamentals. Actually, what we have done was to reverse the role of treatment control, and the results remained unaffected by the other side. So yes, strictly talking, the DID methodology is not in operation since we do not have a control variable that stays unaffected, but the difference gap between not just the numbers and the sizes between these two markets, but for the whole philosophy, the regulatory framework, everything that there is behind these two systems is so massive that we have deemed this approach more easy to comprehend in such cases, to show the initial conclusions that we wanted, and then continue, as you have said, and Professor Sirai said, to continue with why this is happening.
Thanks very much. See another hand raised. Yiping Huang, please go ahead.
Yes, thanks, John. I enjoyed the paper. I guess my question is quite similar to the one raised by Professor Shirai. When I see the difference, the structure change before and after COVID-19, and my immediate question is why? More importantly, I guess it's also related to the point Professor mentioned, because the no cap market behavior probably changed after summer last year. Was that change a short-term reaction to the crisis, or was that really a new trend of the behavior of the two markets? I also have a little bit of issue with the dividing line of the two periods, and you divided at the end of 2019. So your post-COVID-19 start from the January 1st of 2020. We all know the drama really start at the end of January, and I think for the rest of the world, probably February and later on. I don't know if that is going to affect your result, but I think that is very important, because in January, I don't think the result was affected by the COVID-19. The change itself, and I can think of some reasons, for instance, because of COVID-19, because of the restrictions of travel, investors' behavior probably changed. That's one set of the factors you could look at. The other set of factors you could look at, in my imagination, is when the central banks, especially the major central banks around the world, engage in excessively loose monetary policy fighting against the COVID-19. Investors feel your money will lose value so quickly. That's why they start to have more faith in cryptocurrencies. But that may also change. So I certainly think your first step is interesting, but that's not enough to me. I really would like to see a story behind it, and really want to see if this is a short-term, just a fluctuation, or it's a longer-term trend. Thank you.
Thank you very much. Yeah, thank you, John. Thank you very much for your comments. I will start with how we approached the timeline that we needed to divide the two periods. We were looking for something formal, in order to be honest, because the only formal timeline that there was by the WHO, which in its timeline, it declared the start of the pandemic at the end of 2019. Actually, when we tried just as a test to change this timeline and say that the start of the pandemic was 1st of March of 2020, when, as you said, the real drama starting to begin throughout the world, due to the fact that we have added 3 extra months of nothing happening in the pre-era, the changes were even more significant on what we were seeing as the result, because we take a normal period added to the before, and we kept the turbulence time in the after part of the analysis. Regarding the other comments that you have stated, all valid, but the problem that we as economic researchers we have when researching cryptocurrencies is that it's like walking in the dark. You do not have any theory behind it. You can only speculate about why something is happening. So we first try to draw a framework, if I can put it that way, and then add the color in order to be able to, with comments such as this in this fora, we receive valuable information on what to look, because sets of eyes see our study, our framework, and it's easier for us to guide us to see what we are looking for next. Thank you again for your questions.
Thank you very much, Antonis. I would have a question that relates to what Professor Shirai has said. So basically, you're modeling the difference between the crypto and the traditional. But in order to go a little bit deeper, you would at least have to control for the traditional within the crypto equation and vice versa. So I wonder, have you looked at that? Or sought somehow to get at looking beyond just a simple gap between the two?
Yeah.
Yeah. In order to do that, we are developing two different control variables. The one is an index which will capture the herding behavior existing or not in the cryptocurrency market and in the traditional market. So we have an index that will give us information on how the differences between the reaction between these two markets. And the second one is a sentiment analysis index that derives called fears index in the relevant literature, that its information derives by the Google Trends actually database, and how and what people are searching during these times, what are the keywords that they are searching, which are crisis related keywords. So we develop another two indices for both traditional and market and cryptocurrencies markets. So we are looking on the next steps to incorporate these models in order to control. Up until now, what our preliminary results, having only included the fears index, shows that the gap still exists because numbers did not change. But now we can see why this is happening, because looking into the fears index on the sentiment analysis wise, we see heavier interesting by investors. I'm not talking only about professional investors, because cryptocurrency market does not mainly has newbies, if I can talk on that way. So we see how much of a role this sentiment plays in such kind of analysis. So I think that the results will be much more self-explanatory regarding the why question when we incorporate and have the final results of these two indices.
Okay, very good. That sounds excellent. And we would be interested to see the outcome of the additional analysis. I think that's all the questions. You've already had a lot of questions, and thank you very much for your comprehensive answers. There's clearly been a lot of interest in the paper and getting more insights from the findings. So we're going to close the session now. Sorry, we're going to close the session for the break, not completely, and we will reconvene at 6:10. So in around 22 minutes, we will be back.
Thank you very much, John.
Thank you, Antonis. Take care. See you later. Okay, welcome back. So we will have paper number 3 presented by Beza Pursianen. I hope I pronounced at least a little bit correctly, who's an assistant professor at the University of St. Gallen. The paper is entitled Stress Testing Banks, Digital Capabilities, Evidence from the COVID-19 Pandemic. You will have 20 minutes, Beza, so Please go ahead.
Thank you very much, John. Let me try and share my slides. Just a second. Okay, so hopefully, can you see the slides?
Not yet.
Oh.
Like you can see them. Oh, sorry, wait, it's my screen. Oh, no, the slides can be seen. Sorry, my mistake.
Oh, okay.
Go ahead, sorry.
Oh, excellent, thank you. So, good European morning, everybody. And first of all, thank you very much to the organizers for the opportunity to be here today and present this paper. Secondly, apologies, there's a bit of background noise here. There's some renovation going on next to my home office here, so hopefully that's not too distracting. So this paper is joint work with Alan Kwan, Chen Lin, and Ming Chu Tai from the University of Hong Kong. And it's about banks' IT capabilities and how kind of the role that they've played during the pandemic. Now, why do we think that's interesting? Well, basically, so among other things, COVID-19 was a huge kind of unexpected and unprecedented shock to the demand for digital banking. Now, it's hard to find kind of good aggregate numbers on digital banking volumes, but there's a bunch of banks that have published some numbers, so different measures of digital banking or mobile banking, online banking, and so on. And basically, all of these measures sort of showed something like double digits, sometimes almost triple-digit growth during the first wave of the pandemic last year. So that's kind of the backdrop here, and there's obviously there's been some corresponding press coverage with some of the headlines shown here. And then the other observation is that there's also a lot of anecdotal examples that it hasn't always gone particularly smoothly for all banks. So, for example, on the top left corner here, there's a Wall Street Journal headline saying that basically that some firms ended up switching banks because their existing banks couldn't deliver their PPP loans. PPP loans being the SME loan support program in the US. So that's kind of the backdrop for our paper. So basically, and then here's just anecdotal. As I said, it's hard to get good aggregated numbers of online banking or digital banking volumes, but here's some kind of an anecdotal suggestive example. So this is just Google search volume for online banking in the US. And the orange line here is the number of new COVID cases during the last 7 days. And the blue line is the Google search volume in the same period. And basically what you see is once the cases start going up, there's this huge peak in also Google search volumes for online banking. And also, I mean, if you look at the levels here, basically you go from sort of base level of something like 30 to about 60. So there's basically the volume sort of double for this period of time here. And also this is quite unusual. So if you extended this chart further back in time, so you can go any number of years you want to, it's basically kind of a flat line around 30 here. So it's really kind of unusual spike in online banking searches. So that suggests that this is really kind of unusual event in that sense. So basically what we wanted to do in this paper is to see that given this demand shock for digital banking, can we look at whether banks that actually going into the crisis had better digital infrastructure and digital capabilities, were they better able to cope with this increase in digital banking demand, and did they basically perform better? So that's kind of the idea. And then of course, to do that, what we need is basically two things. So we need some kind of meaningful way to measure the bank level IT. And then we need some observable outcomes for these banks that kind of tell us whether they indeed did better or worse during the pandemic. So basically what we do is we construct what we call IT index at the bank level. So this is essentially an index based on the existence of certain technologies that we deemed useful for things like virtual automated remote work. I'll talk about the index a little bit more in a bit. And then we look at different outcomes during the pandemic. So first of all, we look at physical branch visits. We look at website traffic on the bank website. We look at the reaction time, so basically how fast the bank website reacts to the pandemic. We look at PPP loan volume. So this is PPP stands for Paycheck Protection Program. This is the US government's SME support program in the form of government-backed loans, which will be forgiven under certain conditions. And then we look at deposit growth, and finally we look at the likelihood of SMEs to switch banks, so kind of similar to the Wall Street Journal article headline there. So that's kind of the main outcomes we look at here. And then to give you a preview of what the findings are. So what we see is basically that during the pandemic, better bank level IT is associated with, first of all, larger reduction in physical branch visits, and then correspondingly a larger increase in bank website traffic. So basically when the bank has a better IT infrastructure, it looks like there's a larger shift from kind of physical branches to online banking during the pandemic. So that's kind of consistent with the idea that, suddenly it's difficult to go to the branch. You don't want to go to the branch because it could be dangerous. And so if you don't, and if the bank has a better IT, then it's more likely you don't have to go to the branch. So that's kind of consistent with the idea here. Also, better bank IT is associated with earlier mentions of COVID-19 on the bank websites. And also, when we look at the PPP loan volumes, we see that there's basically a positive relationship. So banks that have better IT, they also originate larger volumes of PPP loans to SMEs during the pandemic. And finally, they also see higher deposit growth. So that those are kind of some of the punchline findings. Then on the PPP volumes, so there we have nice kind of geographically disaggregated data, so we can also do a bit more granular analysis cross-sectionally. And so what we see there is basically that the effect of IT on these SME loan volumes is larger for areas that were hit worse by COVID-19. So that's kind of consistent with the idea that IT helps cope with this. It's also larger in areas that have higher internet use, maybe saying something about the kind of IT savviness of the customer base. And it's also, finally, it's largest in areas that have more SME loan competition before the crisis. So basically, the digital service quality seems to matter more when the market is more competitive. Then we also see that SMEs that are located in areas that have worse COVID-19 outbreaks are also more likely to change their lending relationships to a better IT banks. So they're basically more likely to switch to a bank with better IT infrastructure. And then finally, we look at banks' propensity to upgrade their IT during 2020. And we basically see that banks whose kind of geographic footprint was worst affected by COVID-19 are also more likely to increase their IT as measured by our IT index in 2020. So that's, in some sense, that's kind of a validation of our IT measure as well, in the sense that it looks like banks also find these technologies important during the pandemic, and if they're lacking some of them, they're kind of investing in making that up. So that's the kind of main findings. Now, where do we think we kind of fit into the academic literature? So first of all, there's a large literature on the importance of bank branches. So we know that the branch banking in the US and many other countries have been in kind of a steady long run decline, in the sense that there's fewer bank branches over time. But also there's plenty of evidence, even very recent evidence, basically saying that regardless of that, kind of branch closings can have long lasting negative effects. So branches still play an important role in banking. There's also a separate stream of literature saying that technology specifically can reduce reliance on branches. So this is obviously a little bit what we're looking at in this paper. Then there's a separate literature looking at how bank performance is related to IT investment. And the challenge here is, of course, it's kind of difficult to measure IT generally. So most of the measures for IT investment are relatively rough in most of these studies. Maybe the closest paper here is the Pierre and Timmer. They look at basically credit losses of banks during the 2008-2009 financial crisis, depending on the PC adoption levels of the bank. So that's a little bit similar in terms of idea. And then, of course, we're looking at traditional banks and their kind of technology capabilities. But of course, it's somewhat related to fintech generally, and you could argue that fintech is then kind of taking it to the next level in a way. And there's a separate literature on fintech and how on the kind of types of competitive advantage that fintech can provide. And this is in different domains, things like credit analysis, customer service, or possibly tapping some underserved clienteles by the traditional banks. So that's kind of where we think we fit in. And then what we actually do. So we patched together quite a few different databases and data sources. So our IT data come from a company from Aberdeen. So this is, they have something called Computer Intelligence Technology Database. I'll talk a little bit more about that in the next slides. We get our physical branch visit data. It's basically based on mobile phone location data. So we use data from a company called SafeGraph. What they do is they track about 10% of US mobile phones. And based on that, they can tell how many people visit each bank branch each week. So that's the data we use for measuring physical branch visits. Then the website visit data, we use data from a company called Census. It's a cybersecurity firm. They monitor basically the top 1 million websites in the US. So we get a ranking of on a weekly basis of the top 1 million websites in the US, and we can kind of look at relative changes in volumes of website visits. Then we look at the type of technologies that the firm's websites use, and also how the website has looked at different points in time using something called built with. So we can basically go back and see when the bank website mentioned COVID, for example. Then we use the PPP loan level data from the SBA Paycheck Protection Program. So this is data that is publicly available, so anybody can go there and download it. And then also our bank financial information comes from the FDIC call reports, but that's all standard. We use COVID-19 case data from Johns Hopkins. So they provide kind of a granular location-based COVID-19 data. And then we finally use data on local mobility restrictions from Keystone Strategy. So that's a company that tracks these restrictions in the US. So that's basically the main data sources we have here. And then on this IT measurement. So as I said, our IT data come from Aberdeen's Computer Intelligence Technology Database. So what they do is they cover about 3 million plus establishments in the US. This is 85% of all establishments that have more than 10 employees in the US. And what they do is they track the existence of different technologies. So they have a list of about 100 technologies that they track at the establishment level. So what we do here is we went through the list and we tick the technologies that we think ex ante sound like they would be relevant for things like virtual automated remote work. And we constructed an index out of those, basically just summing up dummies indicating whether each of those 14 technologies is present at the office. And then we basically calculate bank level average of the bank offices using employees as a weighting variable there. And the types of software, type of technologies we include in this 14 technologies are basically things like VPN and remote access, document and management, other collaborative software, CRM software, video conferencing and internet phone, database software, and server virtualization, and that kind of things. And here I should say that, if you don't like our IT index, or if you believe we've just cherry picked 14 things to make ourselves look good, we can also do the same analysis, and we do in the paper using the rest. So first of all, we do IT index other. This is basically all the other technologies which we left out from the first index. And we do the same thing. It also works. It's a bit weaker though for some of the results. So it suggests that maybe we pick something that is actually relevant here, but it's still similar directionally. And we can also get the same results using IT staff estimates or IT budget estimates. So it's not any of the results that I'm going to show you is not particularly sensitive to the choice of IT measure in that sense. And here, so why do we pick these things? Well, the idea was something like, so here's again an anecdotal headline from the Financial Times saying that pensioners are warming up to video chat instead of going to the branches. But the idea was basically that, so we know some anecdotal cases where basically banks, for example, so a key bank in the US, what they did is they closed down a bunch of branches, and they trained their branch staff to do essentially operate as call centers from home. So they were doing calls or video calls from home. And so basically, in order to do that, you need these kind of types of technology that we're trying to capture here. So that was a little bit the idea. Suddenly, the banks had to move a lot of their both client-facing as well as operational staff to working from home instead of working from their branches or offices. So that was kind of the idea here. And then here's, so this is the easiest result to show kind of in a chart. So this is just physical branch visits. So this is indexed kind of, so you start from 0 here before the pandemic. What we've done here is we've split all the banks in the US that are in our data. We split them into 3 buckets: the highest IT and the medium IT and lowest IT. So this chart just shows the high-low. Medium would be in between here. But basically the red line is the highest IT banks. The turquoise line here is the lowest IT banks. And what you see is that once the pandemic hits or kicks in here, somewhere around in March, April, there's a substantially larger reduction in branch visits in the highest IT banks. So that would be consistent with the idea that, you know, if you don't have to go to the branch, you don't go. And if the bank has good IT offering, then it's less likely that you have to. So that's kind of consistent with the idea. Here's the same thing, kind of in a more regression format. Here's sort of the left-hand side variable here is the number of branch visits at a given bank branch, given week. So we do this weekly data. And basically what we regress that on is most importantly is interaction of the IT index times dummy indicating that there's mobility restrictions in place. And then we include branch fixed effects and date fixed effects here. But basically what this coefficient here tells you is that once the mobility restrictions come in place, the banks that have higher IT index value see larger reductions in their physical branch visits. And basically that's the same thing here. Here we add the lagged restrictions term here just to check that there's no kind of pre-trend differences, that these banks were not going in different directions before the restrictions, and indeed there is nothing going on there before them.
3 minutes left.
Okay, thank you. So that's it. And then here, basically on the website traffic, we see the exact opposite. So here, basically the left-hand side here is an indicator of website volume. So a larger number means more website volume. And this is exactly the same regression otherwise, although at the bank level. And here you see that there's, you know, banks that have better IT, once there's mobility restrictions kick in, they basically see larger increases in their website traffic. So there's a larger shift from branches to websites. And then here, so this is a bit anecdotal, but again, here, basically all the banks at some point last spring got started, obviously talking about COVID-19 at some point on their websites. So what we did is we basically went back in time and looked at when they started doing that. And here, so this is actually these 2 columns here. This one here is just showing the kind of technological complexity of the website. So basically what we see here is the banks that have higher IT index, they have more sophisticated websites, and they were also faster to react to COVID-19 on their websites. And then finally, I'll talk a little bit about the PPP program. So this was the loan-based SME support program designed to help firms in the US and incentivize them to retain their workforce. So this was done through government-backed loans that were distributed through the banking system. So the loans are originated through banks, but the loans would be forgiven if the funds are used for these eligible items, which are things like payroll costs and rent. And here, so here we do a bank county level regression. So the left-hand side is the PPP loan volume. And basically what we see is banks that have higher IT index tend to originate larger volumes of PPP loans. And importantly here, we control for the earlier SME lending volume of the same bank in the same county. So this is kind of relative to the prior business volume of the same bank in the same location. So that's kind of all consistent with this. And then here, I mentioned some of the cross-sectional differences. So basically, maybe most important, this one here. So this PPP lending volumes, the IT index or the effect of the IT on PPP lending is larger in the areas that have had more COVID cases or more severe outbreaks. So basically, that's all kind of consistent with the idea that those are the areas where it actually matters that you're able to do all these things online. It's also larger in places with higher internet use and places that have a lower concentration, i.e. higher competition. And the final bank level result is we look at the development in deposits. Here, the left-hand side is basically just a kind of relative change in deposits. And we find basically that during the first half of 2020, there's a larger increase in deposits for the banks that have higher IT index. So that's basically it. I think I'm running out of time here, so I'm going to skip a few results. But basically, what we went through the customer switching results already. So basically, SMEs in places that are harder hit by COVID are more likely to switch to better IT banks So that's kind of the final one. And also banks that are harder hit by COVID are more likely to upgrade their IT index in 2020. And as I should say that so on the robustness check, again, if you don't like the IT index, it's not sensitive that we can use IT staff or IT budget, or we can construct a different IT index and it's basically still works. In the paper, we also do some instrumental variables analysis to further alleviate concerns about possible endogeneity of the IT, but I don't really have time to talk about that. So I'm going to conclude here. But basically what we do is we find a positive relationship between banks' IT capabilities going into the pandemic and their ability to serve customers during the pandemic. And more broadly, of course, if you believe our results, then that would kind of suggest that there's a negative relationship between technology and the reliance on physical branches. The interesting thing, of course, is the pandemic kind of escalated this long-running trend toward more digital banking services. And of course, it's going to be interesting to see whether this is the new normal, if it remains so, or whether this is just a blip, and then we're going to come back to physical bank branches once this thing is over. That's of course too early to tell yet. And then finally, the fact that we do find these reasonably strong cross-sectional differences between IT and banking activity suggests that there's a lot of variation between different banks, which also then by implication means that not every bank is equally prepared for this shift to digital. But thank you very much. I'll stop here. I'm very much looking forward to the discussion.
Thank you very much for a very interesting presentation. To discuss the paper, we have Yiping Huang, who's a professor of economics and deputy dean of the National School of Development and director of the Institute of Digital Finance at Peking University. Please go ahead. You have a maximum of 10 minutes. Go ahead. Yes.
Okay. Yeah. Thank you, John. Well, I enjoyed the paper by Visa and a group of respected scholars from University of Hong Kong. And I thought the central question was quite straightforward. Did banks' IT capabilities affect their ability to serve customers during COVID-19? I thought that was probably best illustrated by Visa's figure 1, looking at the impact of COVID-19 on physical visit to the bank branches. Basically, when you have travel restrictions, people stop or reduce their visits to the banks, and then if online activities start to surge. I put one figure on the left. This is from my own study for John, for ADBI. This just shows the businesses of these street side stores during COVID-19. And there are 2 lines here. One is blue. The blue line represents the businesses with online businesses, mostly offline businesses, but some of them have online businesses. And the red line shows the businesses for those without online business. So you can see all businesses collapsed at the beginning of the COVID-19, but the degree of collapse and the recovery were quite different depending on whether or not they have online activities. So this was why I thought that the question the authors raised was pretty straightforward and logical. And this is why I think the findings are in line with the expectation, as Visa just mentioned about the impact on physical visits, on website traffic, on the reaction time by website, origination of the loan, PPP loans, and also the movement of deposits. So these are all very much in line with what I would have thought without doing the study myself. Partly because, well, mainly because the digital technology we're talking about, big tech platforms, big data, AI, and cloud computing, they can increase efficiency in large the scale, improve user experience, and reduce cost and control risks. But most importantly, it's contact-free. So that is why it's useful when the travel restrictions are in place. Now, these findings are very much in line with the expectations. So I don't have any questions about the main findings. I do have a small number of questions to discuss with the authors. And I don't have a fixed answer about these issues, so I will just raise it. Number 1, about the measure of mobility restriction. We know in the US, you have different kinds of restrictions, and the restrictions are implemented in different ways. So I'm not sure if just combine these restrictions would represent different degrees of travel restrictions. It might be, I don't know. So that's one way of looking at. In some other studies, people could just look at the aggregate level of travel by people. That's kind of like the exact result. This is more on the policy. Are there ways to confirming if the result would be the same? The second question about the IVs. Now, they used the non-banking IT and so on. I thought that was quite useful, but it immediately came to my mind. If the bank's capability in serving the customers during COVID-19 would also be affected by non-IT factors, like its economic capabilities or skills of the bankers. And so if that's the case, then the question is the non-bank IT is related to the overall capability, economic capability, or human skills, and so on. If that's the case, then I think there's a question if the IV can purely capture the impact of the IT capability. That's my question. And finally, a question about the PPP, relevance of PPP loans, and I thought it was a good study. But then the next question is, are the PPPs the right loans to look at? Because by definition, I would think the SME loans would probably be more reliant on the IT technology than large corporation loans. So when you see the significant surge of the PPP loans by these banks, is this a result of the IT capability, or was that just simply a fact that even without the COVID-19, you will see the same impact? So these are the technical questions I would like to ask the authors. Now, there are some issues, some difficulties in reading some of the results, and I give you an example. This is the PPP origination, the estimation. So some of the index are quite straightforward. IT index, positive, significant, that's understandable. The log, the CRA loans, positive, significant, understandable. And assets, here assets had a negative, significant impact. I guess the large banks had less PPP loans. Then the question I think the next, which is a little bit difficult to understand, is you have an equity assets ratio and a tier 1 capital ratio, and they have opposite signs. So how should I interpret the impact of capital? Because these are like different measures of capital, but they exactly have the same different opposite signs, and both are significant. And at the bottom also, look at the deposit and assets. Presumably for most banks, these two variables, one way or the other, related. But you also have significant results with opposite signs. Again, I don't know how should we interpret these results. And so just to look at my overall comment, I thought it was a very extremely timely, important, interesting research. And I think what substitutability about the online and offline banking businesses. I thought I was most impressed by the author's efforts mobilizing large volumes of data to compare these all variables. I thought that it was quite unbelievable efforts there, and the findings were certainly very important. However, I'd like to ask a few more questions, and this is beyond the current study. The first question is, what determines banks' IT capability? Is this just a giving, or this is determined by banks' own endowment, or it's determined by other factors? I thought that would be interesting, looking at why they respond differently during COVID-19. The second question is then, well, even if the banks with better IT capabilities serve customers better, but why? What kind of factors really made the difference? And different IT technologies. And in fact, you may also look at the different characteristics of the individuals, of the banks, and maybe the local economic environment. In different environment, technology could function differently. So this is why I would like to encourage the authors to take one step further. The third question, I guess, is, and the author already mentioned that at the end of his remark was this just a simple short-term reaction, or was this a new trend? And finally, there is a question about, well, what does this change mean for the financial industry and the macroeconomy? Just one word about the change in the banking sector. IT capability is one thing which is very important. Digitalization of the banks is changing the landscape of the banking industry. But I guess next thing would be even more interesting to look at is the banks now can utilize the big data for credit risk assessment. We completed a study last year with IMF economists looking at comparing the big data credit risk assessment versus the traditional bank credit risk assessment. I'm not going to get into it, but this is something I suspect that the banks around the world will probably embargo on in the next stage. Thank you very much.
Thank you very much for this discussion, Yiping. So, Veza, would you like to respond to the comments and issues raised? You can spend 5 minutes or so.
Sure. Well, first of all, thank you very much, Yiping. That was a great discussion and a lot of very good points. So yeah, I mean, there's a lot of stuff there. Very good point on looking at the kind of effect of restrictions instead of just the restrictions. That's a valid point. We could actually measure the mobility and we could do something there more directly. So I think that's a very well taken point. On the IVs, I agree. It's a bit written a bit quickly on the paper as it is now. I mean, we think the IVs kind of help in the sense that they rule out some alternative stories. We don't think they're great IVs, so they have these issues, some of which you mentioned. That's why we don't we try not to make too much of a big deal out of them in the paper either, because we don't think they're great instruments, but they marginally help on some alternative explanations, basically. I think you're absolutely right on the PPP loans. They may not be representative of a loan generally, because they're unusual and they're probably more digital by definition. In some sense, you might argue that works against us because we're kind of picking the most IT heavy product out there. At the same time, of course, you could argue the opposite, that this is really a kind of in some sense, really a stress test because this is a product that did not exist before the pandemic, right? So the banks had to kind of put this together out of not quite nothing, because obviously they had some sort of lending capability before that, but this is a new, fundamentally still a new product that they had to launch during the pandemic. So this in some sense, of course, measures, to what extent are they capable of doing these things quickly. So, but that's a fair point, and we should probably discuss that more. Then on your point about the control variables in the bank level analysis, that's perfectly fair. So the focus for us is on the IT stuff, not so much on the control. So we just kind of throw the kitchen sink of variables and of anything we can measure, and just to see that as long as it doesn't move the IT result, we don't really care so much about the other stuff. Of course, it's true. We have two measures of capital adequacy there, which end up giving the opposite signs. Now, it's probably they would give the same sign if you took out one of them. They're obviously very highly correlated, so that's fair. And yeah, so I think then your bigger picture points on the kind of on what are the really the big picture implications going forward. That's all very well taken. So I think what we're relatively convincingly showing in the paper, I think it is that the customer experience was better for the banks that had better IT basically during the crisis. And then what you're asking is basically, well, what does it actually mean? Does it matter for the bigger picture? And that's probably something where we could do more than we're doing at the moment. So that those were great comments. So thank you very much. It was very, very good discussion.
Thanks very much, Veza. I don't see any further questions from the audience, but I would have just one question myself. So a lot of your results obviously hinge on the IT measure. So I think it would be of interest to look at the distribution of that measure and to understand a bit whether there's a large degree of dispersion within that in your cross section. So did you carry out that analysis, and is your analysis also robust to alternative definitions of IT?
Yeah, so we do look at different measures. So I mean, first of all, there is cross-sectional variation, obviously, in the index itself. So there's kind of a fair bit of variation. But we also do look at these alternative measures like IT staff and IT budget. The interesting thing is the results go through with each of those measures. So it's not very sensitive to the measure per se, but actually these measures, so of course, IT staff and IT budget and these IT index are correlated, but they're not super correlated in the sense that if you take like the top 50 banks ranked on each of these measures, the list actually looks quite different. So it's not like whatever you do, you get the same banks there. So it seems like these capture slightly different aspects, but basically each of them seems to work and it seems relevant. So it's not that sensitive to the measure.
Okay, well, thank you very much. I don't see any further questions, so we will now close the paper session. Thanks, Feza, and thanks for the discussion. We will now move to the final session today, which is the final keynote speaker. This will be by Feng Zhu, and to chair the session, we have Raghu Rao, who's the co-founder and academic director at the Cambridge Centre for Alternative Finance, and there's Sir Evelyn de Rothschild, Professor of Finance at the University of Cambridge. So Raghu, I hand the floor to you. Please go ahead.
Thank you very much, John. I'd like to introduce Dr. Feng Zhu, who's currently Senior Director at Luhan Academy and Group. That's where I met him last year. It was a very nice meeting. Before joining the Academy, he was Senior Economist at the Bank of International Settlements. Feng is going to talk a little bit about COVID-19 and the great digital transformation. And obviously, this is a topic of great interest to all of us. So Feng, you have the floor, 20 minutes. And then after that, we have 10 minutes for questions.
Thank you. Thank you very much, Raghu, for your kind introduction. And I also want to thank the organizers for inviting me to this great conference. This is a topic that is very much dear to my heart and also very important for Luhan Academy, as you know. So given the time that I have a lot of slides. I have to go quickly. Let me get into the topic right away. So actually, the global economy has been going through this great digital transformation for some time now, 2 decades at least, let's say. And COVID-19 obviously came at a time of this digital age. So we witnessed the great lockdown, which with the uncertainties of COVID-19 have hurt a lot of the businesses and investments, especially the smaller firms, particularly the micro, small and medium-sized enterprises. It had a direct economic impact and as well as an impact on the digital transformation. So I will talk a little bit about the new big tech business model, particularly the model that we see in China, and also the digital technology that has been essential tool to help overcome COVID. And also we have seen that COVID-19 has boosted digital transformation almost everywhere in this world. So let's think about the digital transformation we have gone through. In the last 2 decades, so if you look at this, you have seen that the most basic economic activities have gone digital. So one of the things that we do is retail sales. We buy things and we enjoy things that we do, right? And obviously, if you look at the graph on the left-hand side, so basically e-commerce has become very common.
Feng, if I can interrupt, I don't think you're sharing the slides.
Oh, I thought that is shared with you.
We can share. Oh yeah, now I think it's going to work now.
Can you see that now? I'm very sorry.
Yes.
So
If you put it on full screen.
Yes, can you see it now?
Yes, now it's perfect. Yes, thank you. Carry on.
Excellent. All right, so if you see on the left-hand graph, you would see that actually e-commerce has been growing very fast, and particularly in China. It's happening everywhere, but in China, in percentage terms, basically went up as 28% of retail sales in 2019. And if you look at the right-hand side, in 2011, digital payment in China was about twice the size of that in the US. In 5 years' time, it's already on the order of magnitude that is far larger than what's in China, what's in the US, and predicted in 2020 and 21 is even much greater. So what's happening is also what we see in digital finance. And if you look at these two graphs, you will see that actually in terms of mobile payments and also in terms of fintech and big tech lending, China is growing very fast comparing to, say, the US or other advanced and emerging economies. Now the big techs in China, they provide financial services as well as non-financial product and services in one single platform or different platforms that they also have. And the single platform that I'm talking about, for example, in the case of Tencent, that's the WeChat Pay. And in the case of Alibaba and Ant, that's Alipay. You go to that and you go to that app and you can get everything. So big tech lending also has reached $516 billion in China in 2019. So what was the impact of COVID-19? So one of the things that we noticed is obviously the great lockdown. And this was the picture in early 2020 up to the 1st of April. And you can see that lockdowns are happening everywhere. And still that's the page that we see nowadays. This is a week ago. And you can see we're still basically in lockdown. I'm here in lockdown. And the most obvious impact on me is that I have a big hair now that I haven't been able to cut in 3 months. So what is happening with technology? What I'm showing you here is basically what Alibaba, some of the things Alibaba and Ant has been doing. So you would see the QR code, the QR health code. With this code, so on the left-hand side corner, you can see the green code will give you the pass. So with this code, you can go into a restaurant, you can go into your workplace. And if you get a red card, you are denied the access. So with this digital app, you can, with this health code, you can basically, get to know whether you are eligible to do things or not. And then, of course, there are also apps that would map the epidemic infections. And also within Alibaba, the Damo Institute, it has come up with an algorithm that helps diagnosis COVID virus through AI. And also the Cainiao, it is the logistics company belonging to the group. It has a green channel for medical supplies. And with DinTalk, you can do all the remote work and online education in China. And one of the most important things that I think has been done by Alibaba and Ant is also that they take the local store online. And this is not only in China. You can see that Lazda has been doing this, for example, in Cameroon and in other countries. So this has helped a lot, actually, to handle the COVID impact. So what about the COVID itself? Is actually, one of the things that we, as economists, we know that is most harmful is the uncertainties about the nature of the shocks, its magnitude, duration, and persistence. So basically, we have been persistently getting it wrong after the COVID shock. So the epidemic has, usually it is a transitory supply side shock, but this one is different. It's far more complex, right? It has simultaneously affected both supply and demand, and also the ensuing epidemic control measures, that kind of source of shocks too. and not to speak of other sources of uncertainties happening during this period. So at the beginning of the COVID, we saw that the markets reacted very, very quickly. Volatilities rose sharply and equity prices fell sharply. And right at that moment, you see a huge capital outflows out of emerging market economies. And these outflows was far larger, actually, say, happened in 2013 when we had the kind of taper tantrum. And I'm suspecting that things are happening again, as we saw the episodes with Turkey very recently. So one of the things that we can remember, probably that was about, say, 100 years ago, we had the 1918 influenza pandemic, which unfortunately was called the Spanish flu, because Spain was neutral. It was not in war. It was only probably the only country that was recording what was happening. So it was basically called the Spanish flu. But the first cases actually were detected in Kansas, United States. And it infected basically 1/3 of the population was population at the time, with very heavy death tolls. So it's very similar to what's happening now, and it's truly global. It's probably one of the most notable pandemics in the industrial age. At a time that actually people did not notice so much because people were busy killing each other. And luckily this time things are different in the digital age, even when people are fighting for vaccines and medical supplies and occasionally for toilet papers. So what are the economic lessons that we have learned in 1918 episodes? This is a work by Kuhey, Lack, and Werner of New York Fed. What they found is that lockdown actually helped. So in the US cities that implemented early and extensive non-pharmaceutical intervention, so basically a sort of lockdown, right? They suffered no adverse economic effects over the medium term. But that's not the case for those who did not do that. And areas most severely affected saw a sharp and persistent decline in real activity. So basically, pandemics can have substantial economic costs, and good measures, particularly lockdown measures, they can lead to better economic outcomes and lower mortality rates. But basically, 1918 lesson was forgotten in the US. And if you see this picture, you see that the real GDP has coming down quite a little bit. And this is in the case of repeated and sizable downward revisions in the US potential output, far lower than what we saw in 2005. In reality, things have gone much worse, right? And the best hope is a V-shaped recovery, and maybe we can return to trend growth. And elsewhere is the same. Basically, if you look at the G7 economies on the left panel, you will see after COVID, they're not doing well. So the red lines are in the global financial crisis, and the blue lines are COVID, and the dashed lines are China. And China is doing much better. So you can see the divergence between China and G7 and Australia. So basically, China had very stringent measures, still have actually, of lockdown, but it's much more relaxed now, and the economy has recovered much faster. And if you look at in different sectors, you will see also the differences. And actually, customer services, so basically the blue dots, their trade, transport, and the recreation industries, they're heavily affected. So they lost much more during COVID than during the global financial crisis, which is reasonable. We expect that. So what are we doing with this digital age? We have a new big tech business model. And this is, I showcase this model, you see that in the US too, but in China it's more apparent, more obvious. And this is what Alibaba ecosystem looks like. So basically, Alibaba is into almost all sorts of businesses. It has online e-commerce, it has digital media and entertainment, it has consumer services, including travel services, it has wholesale commerce, and the very innovative initiatives like DingTalk, which is actually like WeChat is an app where you have the social media going on. And of course, it has logistics, Cainiao, that I mentioned earlier. And what's important is actually the data that is circulating between all these different businesses and payment and financial services and digital marketing. And what's supporting all these things happening is cloud computing. Alibaba Cloud is one of the largest, well, it's the largest in China and one of the largest in the world. And it supports the AI and all machine learning stuff that we have seen in this group. So every part of these businesses become connected, and the data loop is the key. You get all the kind of data from payments and from, from the services. And then with this data, you serve the clients much better, you serve the consumers better. So the data analytics, AI, cloud computing are key to the success. So this is a simple picture. What you see different, it's a little bit outdated, but you can see different groups like Ant Group, Tencent, and JD Finance, how they're supporting the small businesses and consumers in China through different types of apps or services, right? So what's its role in the COVID, right? The whole ecosystem, and particularly the e-commerce that we see, how it relates to COVID. One of the things that we noticed that is the learning by doing role of COVID-19. It changes the consumer behavior. The experience, what we say, experience is the mother of wisdom, right? And the impact is expected to seep in over time and it is going to be very enduring. And that's what we saw actually in Alibaba's experience. And if you look at the left-hand side, you will see that the consumers in advanced economies and emerging economies, they all expect to continue shopping online after the outbreak, except for the case of, say, New Zealand. And I guess, I don't know, maybe some audience can tell me what's happening in Japan and happening in, say, in Germany, or in Italy. That they're not, the behavior does not change that much. But one of the things that we notice is that the older people are turning more vulnerable in the digital age. They adapt less. They're less willing to change. And one of the other thing that we find is that the greater and more frequent e-purchases are happening, right? The e-commerce has been rising, particularly in 2020. And if you look at the time, the vertical line in the middle panel, which indicates 11 March, when the World Health Organization declares the COVID to be a pandemic, actually e-commerce shot up. So it was a deflection point in a way in almost all these economies. But as with SARS in 2003, COVID served as a catalyst for change, boosting e-commerce and digital finance. If you remember, actually, that was the time when Alibaba's Taobao and Alibaba's online sale platform began to actually advance. And so the positive effect would come in the long run, right? And learning by doing is very important. And one of the things that we also notice in the consumption recovery online versus offline is that consumers are far more active online following the COVID-19 outbreak. This is a little bit against what I was against what I thought. This is, by the way, a survey that we did within the Alibaba group. And in terms of number of consumers, online shopping felt much better, rising from 20% to 8% in less than 40 days after the lockdown, basically. But if you look at the consumption recovery and COVID-19, the severity, so the more severe it is, the recovery is slower. So originally I thought maybe, because you have this lockdown and you have these offline businesses going off track, you would have the online business, digital business really, recovering very fast or even, growing very fast, but that's not the case. COVID-19 had a significant impact on e-commerce, particularly when things are very serious. Why? Later, I found out through other surveys that we did with the customers is that it's a likely result of restricted human mobility because logistics and distribution are not working. So basically, however digital you can go, it's still limited by the physical space. What you can do, if you can buy online, but you cannot deliver. The digital world is not working anyway. So what about the payment on the financial side? Of course, COVID actually has a big catalyst for contactless payment, right? So the probability of transmission actually is lower via banknotes than via credit card terminals, pinpads. Many don't know actually, but still there was a clear shift towards digital payments and the central bank digital currency probably that will come. So digital payments, because it's completely contactless, nobody touches what. So it is probably one of the payment modes that has been most supported during the COVID-19 period. And the pandemic has led to shifts in card payment behavior too, as you can see. It boosted card payments. But one of the things that we want to know is, are these effects permanent or transitory? As you can see that actually some of these card payments or card non-present transactions are coming down a little bit in recent times. So the other thing is about CBDC. From the surveys of the BIS, you can see actually the rising ties or rising digital ties and the falling fortunes of cash. Cash use becoming less and less. And obviously, the central banks are more conscious of the need for CBDC. And here, what we can see is also the likelihood of CBDC insurance has increased. So year by year, from 2018 to 2020, more central banks are interested in and receptive to issuing retail or wholesale CBDCs. So what about digital finance? So this is something that Alibaba Ant Group has been doing, and I think it became very useful during the COVID-19. So one thing is, of course, the contactless payment through Alipay, and the other thing is contactless loans. Probably some of you have heard before that MyBank, which was established in 2015, it pioneered the 310 model, 310 model for small and micro firms. And what it does is that it offers collateral-free loans, no collaterals at all. So less than 3 minutes to apply on your cell phone, less than 1 second to approve, and 0 human intervention. So MyBank online survey during the COVID, it suggested that at small and micro firms, 80% of them, out of the universe of 20,000 respondents, they said they needed short-term funding, and 70% told us that they would do well if their funding needs could be met. So to ease COVID cash flow pressures, Ant actually, particularly MyBank, what it did is that it dispersed 1-year loans of about 10 billion Chinese yuan to online merchants from Hubei province on Taobao and Tianmao. And it also offered the loans interest-free for another 3 months. And for the rest 9 months, is the rates are 20% lower. And for the other provinces in China, actually, the 12-month loans of another 10 billion Chinese yuan on Taobao and Tmall, the interest rates are also 20% lower, and is aimed at more than 50 million small and medium-sized enterprises. More than that, actually, one of the things that probably you also noticed on the headlines that MyBank has partnered with 100 banks to launch contactless loans, which is aimed at supporting 10 million SMEs with AI-based risk management. So given the time that I'm coming, let me conclude. So the world has already been immersed in the great digital transformation in the past 2 decades. And we have seen a new big tech business model emerging where data loop and data analytics are the key. And COVID-19 provided a major boost to this process. We saw the dire consequences of the great lockdown, and we also see that digital technology was really helpful. And to be honest, COVID-19, it accelerated the use of e-commerce and digital payment during COVID. And we still want to see what the permanent, the long-term effects would be. And the CBDC has climbed up in priority. Central banks obviously became, more receptive to this idea. And learning by doing, actually, what we saw also in the previous episodes of SARS implied large and enduring effects actually after COVID-19. So the world is going digital, and we're going to see a brave new digital world. But we also notice that there are limits, physical or else, to digitizing the economy. So let me stop here, and thank you very much.
Thank you very much indeed, Feng. That was a really nice presentation. So I do have a couple of questions, and then I'm going to open the floor up to anyone else who wants to ask questions. I did notice that you were talking a lot about, when you were talking about e-commerce, one of the things that struck me is at the end of the day, consumers can buy online, and that's great for them. But there are people who have to deliver it to them, right? So what you're seeing is sort of maybe a shift from relatively higher paying people who are working in shops to much lower paid people who are just delivering stuff to you. Do you see that's positive? I mean, I'm not sure, right?
Sorry, I was struggling with the, very sorry, I was struggling with my computer. I didn't get the question.
Okay,
right.
no problem. Let me try. Is this better?
Yes, please.
So what I was talking about was, when you talked about e-commerce as the accelerated use of e-commerce during COVID-19, one of the things that struck me was at the end of the day, consumers are buying stuff online, right? Which is good for them. But there are still human beings who have to physically pick up the items from wherever it is and deliver them to you. And these people are not paid very much. They don't have any contracts. They don't have any security. So you're replacing a class of people who are relatively better paid with another class of people who are much worse paid and have no job security. So on balance, what do you think is going to happen in the long term? I mean, e-commerce sounds very good, but I'm sure that someone who's delivering would prefer to work in a shop.
Yeah, thank you, Raghu. I think I got your question. This is actually a very big issue in a sense. What you're saying is the kind of inequality or digital divide that is coming along with the world, this digital progress. I'm very sympathetic to this. In a way, it happened like what robotics came, right? Everybody was fearing that robotics would take jobs away, particularly from those without skills. And actually, in a sense, both from evidence that I did also on robotics, and also actually had another picture, but I took it out from the presentation. And actually, you would see the e-commerce is actually employing a lot more people. So people who lost jobs in retails, in offline retails, they went up to serve the online retail businesses, because we know that however digital, as I was saying in the presentation, however digital it goes, it still has to be physical, like you're saying, the word logistics, distribution. So there are other jobs which are waiting for these people. But there is obviously an issue that we need to be aware of, how to help these people actually to do better. And they suffered a lot during COVID. That's what we saw too. A lot of delivery guys, they lost their jobs, or they're stranded in cities in lockdowns. But that's why, the kind of new economy helped. I mentioned the gig economy in the slides. So basically, Ant and Alibaba, they came up with some sorts of new jobs, and they hired these people who temporarily lost their jobs into say the grocery stores, online grocery stores, and other types of professions. But it's an important issue that we need to address, obviously, particularly from a policy perspective.
Exactly. I'm also going to open the floor. I don't want to monopolize all the questions. So let me, if any of the participants have questions, if you can type them into the Q&A or the chat or wherever, very happy to address that.
I would have a question for Feng. Feng, thanks very much for your presentation. So the issue of financial literacy was brought up many times as being one of the impediments to, reaping the benefits. And I wonder is there any evidence of that coming out of China? So, so are people sufficiently financially literate in order to reap the full benefits of this massive acceleration that we've seen in fintech in China? Because it's not always the case for other economies.
That's exactly true. I think you are what you said is very important to us. So within Ant and within Alibaba, there are actually a lot of efforts helping people to understand both in terms of financial literacy, but also in terms of business literacy. So within Ant, there is one platform which is called Chenio. What it does is it helps the small startups to understand how to do businesses, how to do accounting, how to get your marketing down. Because these SMEs, they're so small, they don't have kind of expertise or funds to do this. And Chenio would do that, I think at the beginning would be free for them to use these services. And once they're on the road, once they begin rolling, and then of course they can do better. And then in terms of financial literacy, we have done some work, actually. I think Professor Xiong Wei at Princeton University, he worked with us, and we did experiment on people how to learn asset management. Say, how do you get into these wealth management things, right? And we do see, actually, it was big increase when you let people start to play with the apps and have some sort of experiments with their investment, and they began to know and they began to invest, and that's very similar to online e-commerce. So that's why I think that this learning by doing is very important. And COVID, like SARS, it has an important impact. It forced people to learn a lot of things that we didn't know. We learned, and then we began to understand. Oh, this is doable. Oh, this is so easy. So people began to learn that actually digital, both financial and non-financial services are actually not difficult to do.
Okay, thanks.
I see a question on the Q&A thing. I mean, it's related to the question I asked originally, and you partially answered that as well. So feel free to stay with that answer. The question is, do you think the salary for those who deliver products for online shopping will see an increase? And if so, how do you think that online companies will handle this going forward? You sort of partially talked about that when you talked about Ant Group and how they're helping. But if you have any other thoughts, that's fine. Otherwise, we can go on with that.
So let me say, actually, I have a friend who has restaurants in Portugal. And during this lockdown, of course, the restaurants have to be closed. And they were seriously considering whether they should do, delivery services or not. They eventually did, and they had a contract. So everybody, I think in a way, by regulation, they cannot do just with any delivery. So most of the restaurants have to choose Uber, and Uber does this. And my friend complained to me because the company, I think, is located somewhere else in Europe. So they don't pay taxes in Portugal. And they do the delivery. The restaurant has to pay 20% of their, of the price tag to Uber. So you can imagine what kind of profit the Uber can gain to pay for their delivery workers. So I think in China, delivery is usually not a well-paid job. We know that. But with the demand increasing, actually, I think it boosts, in a way, the salaries of the delivery. But of course, technology changes a lot. And we know that drones, for example, they're coming in, they're in a way, automizing what's happening in the delivery. So this is a very dynamic world that is changing all the time. And I would expect that the wage dynamics will change over time too. And we would see that, I think we would see that people are going to be moving around into different industries. They're moving into the digital industries too. And some will get hurt and some will get benefits.